Every time the Federal Reserve prints money, crashed assets explode upward. If you invested everything before the Fed's money printing started, you'd never have to work again. Just watch your bank account automatically double. This opportunity has only happened twice in history: the 2008 financial crisis and the 2020 pandemic meltdown. But here's the thing, the Fed just announced they're printing money again, and almost nobody noticed. When others don't know but you do, the wealth gap between you widens dramatically. The question is this really good news? Banks hold massive amounts of US Treasury bonds because they're supposedly safe. You're essentially lending money to the US government, but there's a problem. When banks buy treasuries, their money gets frozen. They can't lend to businesses or everyday people. Without access to credit, companies go bankrupt, people lose their homes, and the economy collapses. So the Fed expands its balance sheet by printing money and buying treasuries from banks. This transfers treasuries to the Fed and cash to banks, allowing them to lend again. Simple concept, right? Here's what's happening now. The Fed announced they'll print $40 billion monthly to buy short-term treasuries from banks. Plus, they're collecting $15 billion from other institutions to buy more treasuries. That's $55 billion total every month. Why haven't more people noticed? The Fed changed the name. Previously, when they bought long-term treasuries, it was called QE, quantitative easing. Now they're buying short-term treasuries under a new name, RMP, reverse repo program expansion. But fundamentally, they're still buying treasuries and giving money to banks. This name change drastically reduced attention. Countless people genuinely don't realize the Fed is expanding its balance sheet because of this rebranding. Why is the Fed being so secretive? Historically, they've been loud about stimulus measures, broadcasting to the world that they're swooping in like angels to save the economy. They want to restore confidence and encourage borrowing and investment. So why are they being so quiet this time, even changing the program's name? Because this expansion isn't about stimulating the economy. Consider this: during the 2020 pandemic crash, when the stock market literally hit circuit breakers, and the government had to stop people from selling, the Fed only printed $60 billion monthly. Now they're printing $55 billion monthly, and there's no obvious crisis. What's really happening? Here's another anomaly. In 2008 and 2020, the Fed dropped interest rates to 0% before expanding their balance sheet. 0% rates meant capitalists and the government could borrow massive amounts for free and buy distressed assets at rock-bottom prices during crises. But this time, the Fed has cut rates 5 times, but we're still at 3.75%, nowhere near zero. In America, there's basically high interest or zero interest, when you could previously borrow for free. Paying 3.75% triples your borrowing costs. That's still high interest. Why would the Fed rush to expand the balance sheet while maintaining these high rates, when they could wait and drop to zero first? Either they're delaying a crisis, or the crisis has already begun, and most people just can't see it yet. The Fed is buying short-term treasuries, bonds that mature in 6 months to a year. These are essentially cash equivalents because they unlock quickly. Banks don't desperately need help with short-term bonds because they'll mature soon anyway. So why is the Fed urgently printing money to unlock them? 2 reasons. First, banks are genuinely running out of cash. When you're broke and need immediate funds, you sell your watch and car first, not your house and business. You're just covering emergencies, not liquidating your entire estate. Second, and this is critical, banks can't sell their long-term treasuries because they're underwater. Long-term treasury ETFs have dropped 43% since 2020. At the worst point, they lost half their value. If you're a bank holding $1 trillion in long-term treasuries that have dropped 50% in market value, you face a dilemma. If you hold until maturity in 20 years, you'll still get your trillion back plus interest. It's just a paper loss. But if you sell now to raise cash, you only get $500 billion. That paper loss becomes real, your balance sheet collapses by half, and shareholders and depositors flee. Your bank goes bankrupt. Banks aren't refusing to sell long-term treasuries by choice. They literally cannot sell without triggering collapse. so they're forced to sell their shortest-term assets to the Fed for emergency cash. Remember Silicon Valley Bank? In 2020, they bought massive amounts of long-term treasuries at peak prices when the Fed was doing QE. When the Fed aggressively raised rates in 2022, treasury prices crashed. By 2023, SVB needed cash, sold their underwater treasuries at a loss, and immediately went bankrupt. Other banks survived because they had deposits in the Fed's reserve account. When bank reserves dropped to $3 trillion in 2023, 2 banks failed, and the stock market plummeted 27%. Now, bank reserves have fallen to $2.9 trillion. 2 more banks have collapsed. The Fed has no choice but to quietly intervene and provide liquidity to banks without alerting the world that American banks are in trouble. If dropping rates to zero would solve everything by making long-term treasuries valuable again, why doesn't the Fed just do it? Here's the problem. Despite 5 rate cuts bringing the Fed funds rate to 3.75%, long-term treasury yields haven't fallen. They've actually increased to 4.78%. The market is demanding higher yields because nobody wants to buy them. There's only one scenario where people flood back into long-term treasuries: a full-blown crisis. When stocks and real estate crash, treasuries become the only safe haven. Only when the financial system is burning will money rush from risky assets into treasuries. Only then can the Fed drop rates to zero and massively expand the balance sheet. And conveniently, the US seems to be actively puncturing the AI stock bubble. ChatGPT sparked global mania about AI replacing humans within years. Any stock connected to it multiplied several times over, but now, Wall Street is questioning whether AI investments can ever be profitable. Stocks that soared are crashing. Nvidia down 20%, Oracle down 48%, Meta down 26%. Since 2008, American wages haven't kept pace with asset prices or inflation. Real income has been shrinking. A salary that supported a family in the past barely supports one person now. So how do Americans maintain their lifestyle and drive 70% of economic growth through consumption? They've gone all in on stocks. They're not buying bonds or insurance. They're buying stocks, often with borrowed money, because stock returns have far outpaced wages since 2008. American wealth depends entirely on rising stock prices. If you rely only on salary, you get poorer. The stock market is the only path forward. But leverage levels now match 2000 and 2008, the 2 biggest crashes in recent history. The Fed can't prevent crashes, they just shorten them. The 2020 pandemic crash was brief because the Fed immediately dropped rates to zero and printed massively. April's stock correction was contained by delaying tariffs and removing negative news. The system allows significant crashes but minimizes their duration. Without crashes, money won't flee to long-term treasuries, and the Fed can't print massively to push stocks even higher. The next crash could rival 2000 and 2008 in magnitude, but it will be brief, a rapid wealth transfer from those forced to sell assets cheap to those ready to buy. The Fed is already buying short-term treasuries. Bank reserves are dangerously low. The timeline to stocks crashing and money rushing into long-term treasuries is compressing. When the smoke clears and the reset completes, that's when the real opportunities appear, not before.